If you were born in the 1940s, the 1950s, or the 1960s, I need you to stay with me for the next several minutes, because the Social Security rules that apply to someone born in 1948 are not the same as the rules that apply to someone born in 1955, and they are different again from someone born in 1963. The changes that took effect in 2026 did not hit all three groups equally, and that is exactly why most general Social Security videos are not giving you the full picture. This video is going to walk through what 2026 means specifically for your birth group, what action each group needs to take, and what happens to your monthly payment if you simply do nothing. My name is Mason Parker. For over a decade, I have studied retirement benefits, senior tax programs, and the financial rules that cost seniors thousands of dollars every year because nobody sat them down and explained what applied specifically to them. Now, let me give you the foundation before we go into each group, because this one table changes how you read everything else in this video. Your full retirement age is the anchor for every calculation that follows. Here is where each birth year stands. Born 1943 through 1954, your full retirement age is 66 exactly. Born 1955, it is 66 and 2 months. Born 1956, 66 and 4 months. Born 1957, 66 and 6 months. Born 1958, 66 and 8 months. Born 1959, 66 and 10 months. And if you were born in 1960 or any year after that, your full retirement age is 67 exactly. That is now final. The 4-year gradual increase that began with the 1983 Social Security amendments is complete. 3 things I want you to hold on to through this entire video. First, claiming before your full retirement age produces a permanent monthly reduction that never adjusts back. Second, every year you delay past full retirement age up to age 70 adds 8% permanently. Third, the SSA will process whatever you submit without volunteering the full dollar comparison between your options, unless you ask for it specifically. 3 groups. Let us start with the oldest. If you were born in the 1940s, you are somewhere between 77 and 86 years old. You have been receiving Social Security for anywhere from 7 to 23 years, depending on when you originally filed. And the 3 issues I'm about to cover are the ones most likely to be quietly affecting your check right now without your knowledge. The Social Security Fairness Act eliminated the windfall elimination provision and the government pension offset, retroactive to January 2024. By mid-2025, the SSA had distributed over $17 billion to more than 3 million people. But a significant number of seniors in this birth group have not received their correction, and the reason is more straightforward than most people expect. Many seniors born in the 1940s have relocated since they originally submitted their Social Security claim and have not updated their mailing address with the SSA. Correction notices go to the address on file. If that address is no longer current, the notice arrives somewhere else, and the response window runs out while you are still waiting for something that already came and went. What to do? Call the SSA at 1-800-772-1213 and say exactly this. I want to verify whether my account has been fully corrected under the Social Security Fairness Act for WEP or GPO, and whether any notices were sent to an address that may no longer be current. If a notice was sent to an old address, ask for it to be reissued to your current address and the start date of any response from the newly issued date. Also, log in to ssa.gov and update your contact information directly if you have moved at any point since filing. People born in the 1940s built their careers during an era when payroll was processed by hand. A business owner with a ledger, a bookkeeper with a typewriter. Wages reported to the SSA in the 1960s and 1970s were submitted manually, and honest mistakes in those submissions were significantly more common than they are today. Social Security calculates your benefit from your 35 highest earning years. 1 year on your record that shows 0 when you were actually working pulls your entire average down. According to SSA data, a single year of missing or inaccurate earnings reduces your monthly benefit by approximately $100. Over a 20-year retirement, that one wrong year costs $24,000. If 2 or 3 years are off, the number multiplies. The SSA does not correct these errors on your behalf. There is no automatic review. The error sits there, silently, reducing every check until you personally open the statement and look. There is a specific issue that affects women in this birth group more than any other. Women born in the 1940s who changed their name at marriage and did not immediately update with the SSA often have early career earnings that were recorded under a maiden name and never correctly linked to their current Social Security number. Decades of work from the 1960s may be sitting in the SSA system credited to nobody. A wage trace investigation can be requested directly from the SSA at no cost. Log in to ssa.gov and open your earnings history. Go through it year by year. Look for zeros or low figures in years when you know you were working, especially the 1960s and 1970s. If you find a discrepancy, the correction form is Form SSA 7008. It must be mailed or hand-delivered to your local SSA office. It cannot be filed online. Sign it in ink before mailing. An unsigned form is treated as if it was never filed. Many widows and widowers in their late 70s and 80s are collecting their own Social Security benefit when the survivor benefit on their late spouse's record would be significantly higher. A survivor benefit can be up to 100% of what the deceased spouse was receiving. If you have never specifically asked the SSA to compare both figures, that comparison has never been made on your behalf. Call 1-800-772-1213 and ask them to pull both your own benefit and any survivor benefit you qualify for and tell you which produces a higher monthly payment. That phone call is free, and it has added hundreds of dollars per month to the checks of seniors who had been collecting a lower amount for years simply because nobody ever made the comparison. If your late spouse worked in public service and their benefit was previously reduced by the windfall elimination provision, the recalculation under the Fairness Act may have changed the base used to calculate your survivor benefit. Ask the SSA specifically whether your survivor benefit calculation reflects the updated post-Fairness Act figures. If you have never checked your earnings record year by year, there is a real chance an error from the manual payroll era is quietly reducing your monthly check right now, and has been for years. Every step to find it, and the free IRS tool that retrieves records going back to 1978, even if you have no paperwork left, is documented in the Senior Money Defense Playbook. The link is in the description below. If you were born in the 1950s, you are somewhere between 67 and 76 years old. Some of you have been collecting Social Security for years. Some filed recently, and some are still actively making decisions about when and how to claim. All three situations have something specific and actionable happening in 2026 that I want to make sure you understand before this month is out. The 1950s birth group spans a range of full retirement ages, and the specific month matters more than most people in this group realize. If you were born between 1943 and 1954, your full retirement age was 66, exactly. If you were born in 1955, it was 66 and 2 months. 1956, 66 and 4 months. 1957, 66 and 6 months. 1958, 66 and 8 months. 1959, 66 and 10 months. Here is why the specific month matters. A senior born in 1957, whose full retirement age was 66 and 6 months, who filed the month they turned 66, received a permanent reduction of approximately 3.3% on a $2,500 monthly benefit. That is $82.25 less every single month, permanently. $990 per year, nearly $20,000 over a 20-year retirement, not because they filed years early, because they filed 6 months before their actual full retirement age and never knew the difference. If you filed at or near 66 and you were born between 1955 and 1959, pull your original Social Security award letter and confirm the exact claiming age that was recorded. If you filed before your specific full retirement age by even a few months, your benefit carries a small but permanent reduction that has been compounding in lost income ever since. If you worked in public sector employment at any point in your career, a state or local government job, a public school system, a federal agency before 1984, or any employer that did not withhold Social Security taxes from your paycheck, your benefit may have been reduced by the windfall elimination provision or eliminated by the government pension offset. The Fairness Act eliminated both provisions, retroactive to January 2024. For most people in this birth group who are already receiving a reduced benefit, the correction was processed automatically. But a meaningful number of 1950 seniors have a payment sitting in a processing queue right now that has not been released. And the reason is often simpler than people expect. Before the SSA releases a recalculated benefit amount or a retroactive payment, they need confirmed banking information. If your direct deposit details were updated at any point in the last 2 to 3 years, or if you simply have not verified them recently, your payment may be waiting on a confirmation step that nobody has reached out to tell you needs to happen. Call 1-800-772-1213 and ask 3 specific questions. First, is there a pending WEP or GPO recalculation on my account? Second, has a retroactive payment been calculated on my behalf? Third, is the direct deposit information currently on file confirmed and up to date for the release of any pending payment? That single call could release a payment that has been sitting in a queue for months. Retroactive payments for people affected by both WEP and GPO are averaging between $4,000 and $8,500, depending on how long the reduction was applied. If you claim Social Security before your full retirement age and you are now past it, one option is still available that most seniors in this group never hear about. It is called voluntary suspension. Once you have reached your full retirement age, you can ask the SSA to suspend your benefit. During suspension, you earn delayed retirement credits at 8% per year. Every year you suspend up to age 70 adds 8% permanently to your monthly amount when it resumes. A senior who claimed at 62 and is now at 68 with a current monthly benefit of $1,500 who suspends for 2 years to age 70 adds 16% to that amount. At 70, the benefit resumes at $1,740 per month. That is $240 more every month permanently. The cost is the foregone payments during suspension. Whether suspension makes sense depends on your health, your other income sources, and how much you depend on the monthly payment during the suspension period. One critical warning before you request suspension. During voluntary suspension, any benefit another person is receiving on your record, including a spouse, is also suspended for the same period. This must be factored into the household decision before you make the call. If you are still working while collecting Social Security before your full retirement age, the 2026 earnings limit below FRA is $24,480. For every $2 you earn above that, $1 in benefits is withheld. But that withheld money is not gone. Once you reach full retirement age, the SSA recalculates your benefit upward to credit you for every month benefits were withheld. The earnings test is not a penalty, it is a deferral, and understanding that distinction changes how you think about working while collecting. The claiming decision and the tax calculation that follows it are 2 separate things most seniors never run at the same time. Whether the IRS taxes your benefit and how much depends on a provisional income formula that most financial advisors never present alongside the claiming timeline. The Senior Money Defense Playbook has a 5-step worksheet that covers both the claiming math and the tax math in one place. The link is in the description below. This is the section I told you to stay for at the beginning of this video. If you were born in the 1960s, you are somewhere between 61 and 66 years old. You are either approaching Social Security eligibility for the first time, actively making the claiming decision right now, or you filed recently and the decision is still fresh enough to revisit. All 3 situations have something specific happening in 2026 that carries permanent consequences if you get it wrong. If you were born in 1960 or any year after that, your full retirement age is exactly 67. This is the final step in a 42-year gradual increase that began with the 1983 Social Security amendments. There are no more months being added, no more incremental adjustments. For your entire birth group, the number is 67, and it is not changing. This matters because every calculation your Social Security decision is anchored to that number. The permanent reduction for claiming early is measured from 67. The delayed retirement credit for waiting past 67 is measured from 67. And the survivor benefit your spouse would inherit is based on what you locked in relative to 67. Here is what the numbers actually look like in 2026 for this birth group. The maximum monthly benefit at full retirement age in 2026 is $4,152. At age 62, the earliest possible claim, the maximum drops to $2,969. That is a permanent 30% reduction that applies every month for the rest of your life. At age 70, the maximum rises to $5,181. That is 24% above the full retirement age amount, also permanent. On a more typical full retirement age benefit of $2,000 per month, claiming at 62 produces $1,400. Waiting to 70 produces $2,480. The monthly difference is $1,080. Over 20 years of retirement, that monthly difference accumulates to $259,200. The SSA will process your application at 62 without presenting those numbers to you side by side unless you specifically ask for the comparison before you sign. Many people born in the 1960s who are considering claiming at 62 or 63 are still working. And this is where a misunderstanding about the earnings test costs people money in two different directions. The 2026 earnings limit for someone collecting Social Security before their full retirement age is $24,480 per year. For every $2 you earn above that limit, $1 in benefits is withheld. In the calendar year you reach your full retirement age, the limit rises to $65,160, and the withholding drops to $1 for every $3 earned above the limit. Here is what most seniors in this group never hear. The withheld money is not gone. Once you reach full retirement age at 67, the SSA recalculates your benefit upward to credit you for every month during which benefits were withheld. The earnings test is a deferral, not a penalty. You get those months back in the form of a permanently higher monthly check after 67. What this means practically is that a senior born in 1963 who is still earning $60,000 per year and is considering claiming at 62 is in the worst possible position. They would receive a permanently reduced benefit that is then further reduced by the earnings test, and they would recover the withheld portion after 67, but never recover the permanent early claiming reduction. In almost every case where someone in the 1960s group is still working full-time with meaningful income, waiting to claim produces a significantly better outcome than filing early and losing ground on two fronts simultaneously. For married couples, where one or both spouses were born in the 1960s, the claiming decision is not only about the filer's own income, it is about what the surviving spouse receives after the higher earner passes away. When the higher earning spouse dies, the surviving spouse receives whichever monthly benefit is larger, their own or the deceased spouse's full benefit. The amount the higher earner locked in at their claiming age is what the survivor inherits. A higher earning spouse born in 1962 who claims at 62 and locks in $1,400 per month leaves a surviving spouse with a $1,400 survivor benefit. The same spouse who waits to 70 and locks in a surviving spouse with $2,489. That difference follows the surviving spouse for the rest of their life and can spend decades of widowhood. For couples where one spouse is in better health, has a higher earning record, and is younger or the same age, that spouse delaying to 70 may be the single most valuable financial decision available to the household. If you filed for Social Security within the last 12 months and you are reading this and rethinking that decision, one option still exists. Form SSA 521, Request for Withdrawal of Application. You repay every dollar you received, including any Medicare premiums withheld. The application is reversed completely, and you are treated by the SSA as if you never filed. You can then reapply at a later age and lock in a permanently higher amount. This option expires exactly 12 months from your original application date. It is available once in a lifetime. If you filed recently and have any reservations about the claiming age you selected, call 1-800-772-2727 1213 this week and ask about Form SSA 521 before the window closes on your specific application date. Let me bring all three groups together with one clear action list. Everything on this list is free. Everything is based on rules already in effect. And for the 1960s group in particular, some of these actions have a closing window that does not reopen. If you were born in the 1940s, call 1-800-772-1213 this week and confirm that your current mailing address on file with the SSA is accurate. If you have moved at any point since originally filing, update it today. Then ask the representative directly whether any Fairness Act correction notice was sent to an address that is no longer current, and request reissuance if needed. Log into ssa.gov and open your earnings history. Go through it year by year against whatever records you have. Look for zeros or low figures in years when you know you were working, especially the 1960s and 1970s. If you find a discrepancy, request Form SSA 7008 from the SSA. Complete it, sign it in ink, and mail it by certified mail to your local SSA office. If you are a widow or widower, call the SSA and ask them to compare your own monthly benefit against any survivor benefit you qualify for. Ask specifically whether your survivor benefit calculation reflects the updated post-Fairness Act figures for a spouse who worked in public service. That comparison is free and has added hundreds of dollars per month to checks of seniors who simply never asked. If you were born in the 1950s, if you worked in public sector employment at any point in your career, call 1-800-772-1213 and ask these three questions in this order. Is there a pending WEP or GPO recalculation on my account? Has a retroactive payment been calculated on my behalf? And is the direct deposit information currently on file, confirmed, and up to date for the release of any pending payment? If you claim Social Security before your full retirement age and are now past it, ask the SSA about voluntary suspension. Run the break-even calculation before deciding. And if you are working while collecting before your full retirement age, understand that withheld earnings under the earnings test come back as a permanently higher check after you reach FRA. If you were born in the 1960s, before you file or before you make any final decision about your claiming age, call 1-800-772-1213 and ask the SSA for three specific figures: your estimated benefit at 62, your estimated benefit at your full retirement age of 67, and your estimated benefit at 70. With those three numbers in front of you, calculate the monthly difference between 62 and 70 and multiply it by 240. That is the 20-year lifetime gap your claiming decision creates. If you are still working with meaningful income, run the earnings test calculation before filing early. In most cases where income exceeds $24,480, waiting produces a significantly better outcome than filing and losing ground on two fronts simultaneously. If you filed within the last 12 months and have reservations about the claiming age you selected, call the SSA this week and ask about Form SSA 521. That withdrawal window closes exactly 12 months from your original application date and does not reopen. 3 birth groups, 3 different sets of rules, 3 different actions that need to happen now rather than later. The SSA processes what you submit. It pays what is claimed. It does not call to tell you that a Fairness Act correction notice went to an old address, that a retroactive payment is sitting in a queue waiting for a confirmation step, or that the benefit you locked in at 62 will cost you $259,596 over 20 years compared to waiting until 70. That gap between what the system does automatically and what it explains voluntarily is where the money gets lost. You now know which group you are in and what specifically applies to you. The action steps above are what turn that knowledge into a larger monthly check. I want to speak directly to the people watching this who realized somewhere in this video that they have been leaving money on the table. A correction notice they never received, a retroactive payment sitting unclaimed, a claiming decision made at 62 without anyone showing them the lifetime dollar math first. If that describes your situation, the next step is not another video. The next step is having every rule, every form, every phone number, and every deadline in one place, so you can act on it today rather than losing another month. That is exactly what I built the Senior Money Defense Playbook for. It covers the earnings record correction process with Form SSA 7008 in full detail. It covers the survivor benefit comparison and exactly how to request it. It covers the provisional income formula that determines whether your Social Security is even being taxed correctly. It covers the W-4V fix, the IRMAA surcharge you can stop with one form, the joint account mistake most seniors make out of love, and 6 other rules that are affecting your money right now in 2026. Plain English. Every form named, every phone number listed, every deadline marked. If even one chapter recovers a single month of a benefit correction you were owed, the guide has paid for itself many times over. The link is in the description below this video and in the channel bio. Get it today. Not this weekend, today. Because 2 of the deadlines inside it are closing this calendar year. Subscribe and turn on the notification bell. Every Social Security rule change, every correction window, every deadline that affects your payment, this channel covers it in plain language before it costs you. Share this video with one person in your household or extended family born in any of these 3 decades. The conversation you start by sharing this video could be worth thousands of dollars to someone you love. I will see you in the next one.